Yet, even as Treasury Secretary Stephen Mnuchin said earlier today on our air, a lot of work that still needs to get done. Guys?
Eunice, thank you for bringing us the China perspective on this. For more on the trade impact on the markets, joining us now is Invesco Vice Chair of Investments Krishna Mamani and JP Morgan Asset Management Global Market Strategist Gabriela Santos, both here at Post 9. Gabriela, I'll start with you. Is this an agreement, or is this an agreement to try and reach an agreement? And based on that answer, how do the markets move from here?
It's an agreement to postpone the escalation that was planned for tomorrow and to continue talking over the next few weeks. So for us, I think it's right to temper the enthusiasm a little bit after such a huge rally we had on Friday. It's not locked down. Number two, even if we end up having a phase one written down truce, it doesn't remove the uncertainty cloud going into the election. And number three, we have also some just late cycle concerns to think about, which should come to the forefront as earnings season picks back up this week.
Krishna, tariffs that are already in place, they're not going anywhere. You still have this overhang of potential additional tariffs on more imports from China here in the U.S. come December. How does the market digest this?
Well, so I think the most important point to remember in this regard is for the markets to go higher, given the policy moves that we have seen on the monetary policy side. We just need the trade issue to not get exacerbated.
Is that all we need?
Yes, that's all we need.
That's going to lift business and CEO sentiment.
I think there's the cyclicality of the monetary policy regime is going to kick in by the end of this year and by early part of next year. So the outlook for growth is going to be meaningfully better. Rates remain low, policy is supportive, and economic growth actually stabilizes and picks up. The uptrend in the market has to be driven by that rather than the expectations of a trade deal. All we need is for things to not get worse.
Are you talking about the trickle down of Fed policy? Well, two cuts restores all faith in the world?
Well, no, it's not about trickling down of Fed policy. It's really about the Fed not tightening and making things far worse. I think if you go back and look at the slowdown in the first half of the year, part of it was trade-related, but a lot of it was related to what the Fed did in 2018. A reversal of that and support of monetary policy, not just from the Fed, from the ECB and world over. I think that's what the markets are going to be built off of.
And you've been focused on the strength of the consumer as kind of the bright spot here. And I know you've also talked about that being a life vest for this economy as it continues to chug along. Are there any headwinds that you see as it relates to the trade deal and the trickle effect that it has on the consumer?
Well, so I think the manufacturing part of the economy was slowing down for quite some time. And I think that, in my judgment, has kind of bottomed out with the reversal in policy. The consumer part of the economy continues to do very well. Income growth, unemployment, and and debt load, debt service capability, all of that is very good. And I think that will continue to support the consumption for the foreseeable future.
So I think we also would agree that no escalation on trade and support of central banks, it does help to reduce the recession odds, right? So we are not of the base case that there is a recession. But we also temper a little bit our enthusiasm of how much these two variables can really lift U.S. and global growth from here. So for us, it's a story of muted economic and earnings growth, and as a result, positive but modest risk asset returns. So
I think that point is an important one. That is, even when you're looking for markets to go up, it's not, moving up in a big way. So our outlook for year end is somewhere close to 3,100, which is not too far from where we are. But I think the outlook for 2020 onwards increases meaningfully because the global economy is bottoming out. Just go back and look at how things panned out in 2016. Once you have the policy, once you have the big odds kind of taken out, there is enough momentum in the economy for it to provide decent support.
So basically, you're talking mid-cycle.
Right? Absolutely,
Mid-cycle.
4 more years. So when I had come here before, I had said that this cycle will continue for another 5 years. That was last year. So 4 more years.
Right. And JP Morgan's nowhere near that, right? You're more of a late cycle case.
We are more of a late cycle case. And I think it'll be really interesting to start watching the third quarter earnings season, right? So away from trade, away from central banks, just looking at where we are in the cycle. And you're starting to see those margin pressures, right? We saw that in the first half of the year. And I don't think that goes away with a trade truce or with support of central banks.
That's sort of like the weird case right now, is that inflation ends up being the one that did us in.
Well, so if inflation picks up meaningfully, then it's all over. But I don't think the likelihood of that is very high. I think from an earnings perspective, let's just remember one thing. Focusing too much on third quarter earnings, actual earnings, as to what the future outlook is, I think that is misplaced. What you should be looking for is what people are saying with respect to the bottoming out that they are seeing in their respective businesses. That will tell you what the outlook is for 2020, not what third quarter earnings were.
So, Gabrielle, do earnings expectations for 2020 need to come down, or do we just need to wait and see?
Absolutely. We still have consensus looking for 11% earnings growth in 2020. Even if we do have a bottoming out here in terms of growth, lower recession odds, the late cycle dynamics are still at play. You're not going to have margin expansion going into 2020. So these 11% earnings growth expectations do need to come down, into our mind, closer to something between 3 and 5%.
I think that argument crystallizes what's going on. Either it is late cycle or mid cycle. It's really not about trade. Trade is just a sideshow at the moment.
But neither of you are saying it's end of cycle.
Exactly. That's a crucial distinction.
Okay. Thanks for joining us today, Krishna and Gabriella, as the markets turn fractionally higher.
Speaking of those trade talks last week, we did hear from the Treasury Secretary earlier this morning, who was on Squawk. Take a listen.
I don't think that's fair at all. There's a fundamental agreement in principle. We've gone through these chapters many times. There are still some issues that need to be worked out in wording, but I would say we have every expectation that phase one will close.
Joining us this morning, first on CNBC, former Treasury Secretary Larry Summers. Mr. Secretary, good to have you back.
Good to be back.
All right, so your read, based on what we heard here last week and now how this is all being telegraphed in Beijing.
I don't think this is a big deal. The agreement may well close, but I don't think it will address the fundamental overhang of tension and uncertainty that's been created in the U.S.-China relationship, and that will inhibit spending plans and business investment on both sides of the Pacific. This is not an event that anybody will remember for a long time, one way or the other.
Does this lead us then into a multi-year pattern of tariff risk, tariff threats, talk of escalation, and muted capex and hiring? What happens now?
I think without some creative diplomacy, without the U.S. administration establishing some consistency and credibility in the pattern of its responses, without some effort to make this a more global approach to China, I suspect we're going to be mired in the current kind of difficulties for quite some time, and I think it will be one of the adverse factors affecting the economy.
So it's hard to imagine any kind of multilateral relationship beginning here ahead of the election, unless you think I'm mistaken on that one.
No, I think you're right. I think that we're in a difficult place, given the political strains on both sides, given the concerns about the economies on both sides. I think this is going to be a problem that didn't get made in a month or a year, and I don't think it's going to get resolved overnight.
Obviously, this is just phase one.
Go ahead.
Oh, sorry, Larry, go ahead.
I think the market's probably overly sensitive to the day-to-day dynamics of these negotiations, and perhaps insufficiently sensitive to the broader risks of a cleavage between the world's two largest economies.
And obviously that interconnectivity coming into focus, with regard to this trade war. And phase one didn't exactly include any details on what to do about Huawei, what to do about the Hong Kong protests. How much do you think that those will be a bargaining chip as these talks continue?
I think those are going to be important issues. I think the broad set of issues around technological leadership, around cyber security are likely to be difficult over time. I think there's a very broad set of questions about, are we going to have one integrated global economy, or are we going to have a splinter net with an American sphere and a Chinese sphere? Those are the really fundamental questions, and that's not what these trade negotiators are haggling about when they talk about purchases of pork and the like. And that's what's much more important for how the global economy evolves.
Yeah, so let's dig into that a little bit more, Larry, because if you do see tariffs persist, if you do see tensions and talks persist, I mean, one thing is certain here, and that is what was normal and how the global economy operated, trade flows operated before, we're probably never going back to it. That normal is gone, right? So looking out over the coming not only months, but also years, what does this relationship between the U.S. and China ultimately look like, and what does that mean for the global economy?
I think you're going to see a shortening of supply chains. You're going to see a reorganization of supply chains to be more local. That's going to have a price in terms of efficiency. That's going to have a price in terms of how well the global economy functions, and particularly during a period of adjustment, can only operate to generate more slowness. Then you're going to have, I think, a greater overhang of uncertainty about the possibility of conflict, about the possibility of a very large-scale splintering and reduction of interdependence, and that uncertainty is going to cause people to feel a need to invest less and perhaps to save more, maintain more liquidity. That's going to exacerbate the tendency towards low interest rates without rapid growth that we've seen in recent years. And ultimately, there's going to be security concerns in a world where the two powers could become more starkly opposed. I'm not sure that all of that has to happen, but it's certainly the path that the world is on right now.
Finally, Mr. Secretary, it sort of leads us to a discussion we were having before our discussion, and that is about the business cycle, what this prolonged uncertainty would do to the cycle, whether tariffs are inflationary or disinflationary. I'm going to guess you think it's the latter.
I think the deflationary and disinflationary risks right now are much greater than the inflationary risk. I certainly think we're very late in this cycle. I think the odds of a recession starting by the end of 2020 are probably below 50%, but I don't think they're a lot below 50%. And I think the risk that recession will start in the next several years have to be better than even. And I think the great concern is with what I've called the monetary black hole, that zero rates appear to be where we're stuck in Europe and Japan, and we're one recession away from a situation of that kind. It's a very different world when everyone's stuck at zero interest rates. We're going to have to think about stabilization policy. Institutions are going to have to think about their investment policy in a very different world, in a very different way when we have black hole, zero interest rate world, and that's what I fear we're headed into.
We took a shot there of your op-ed in the FT the other day on that exact topic. A lot more to discuss in the weeks and months to come. Mr. Secretary, thanks for the time.
Good to be with you.
When we come back, the quote, unwinnable trade war, while our next guest says everyone loses in the U.S.-Chinese clash, but especially Americans. The head of one of the largest private equity firms in Asia joins us next. Walk on the Street. We'll be right back.
Right now, the future is being written by people like you. Creative thinkers, tech lovers, problem solvers. Are you going to stand by and watch? Well, show the world what you've got. Join others around the UK on an EY degree apprenticeship in digital and technology. And earn a salary working with exciting businesses while studying towards a degree. Don't let the future pass you by. Get involved. For more information and to apply, search EY Digital Apprentice.
She did it! Her first word! Go on, say it again for Mummy.
Nada. Mama.
Oh.
Savings.
Did you hear that?
Savings account.
Teaching your kids how to save may not be this easy, but you can get them learning good habits and skills from an early age, thanks to the range of children's savings accounts from Yorkshire Building Society. Just another example of real help with real life. Find out more at ybs.co.uk.
We could play epic music, or we could speak in an overdramatic tone, or even set off fireworks. But that's just not smarty. Instead, we let our offer do the talking. Right now, you can grab 25% off our unlimited data SIM. That's just $18.75 a month with no speed restrictions, no credit check, and no long contract to tie you in. Now that's smarty. Just search Smarty Mobile and switch today. It's easy. Offer available for a limited time only. See smarty.co.uk for terms.
Get ready for Brexit on the 31st of October. Brexit will bring changes that affect businesses in many ways, particularly if you buy from EU suppliers, sell to EU customers, provide services to EU clients, and receive customer data from other businesses in the EU. Businesses need to prepare. Find out how at gov.uk/Brexit. Get ready for Brexit on the 31st of October.
Carl's all-change casserole.
So, Chloe walks in from school. Tears all over her face.
Daddy,
She says,
I don't want to eat animals anymore.
I blooming love my meat, but not as much as I love my little girl. That's why we've made some changes to our old favourite, sausage casserole. Now with meat-free Cumberlands, but still with my magic touch. A dollop of mango chutney. Just as tasty as it used to be.
Better, actually.
Make your own with the new Tesco Plant Chef range. Food Love Stories. Brought to you by Tesco.
Stocks obviously mixed today. Dow's up, S&P's down as China tempers some trade optimism, saying it wants to talk more before signing a deal with the United States. Joining us in an exclusive interview this morning is billionaire financier Wei-Jin Shan, chairman and CEO of PAG, one of Asia's largest private equity firms, and he's out with a new op-ed in which he says everyone loses in the U.S.-Chinese clash, but especially Americans. Shan, thanks for your time today. Good to have you back.
Thank you. Good to be here.
Give us the framework for how you see this this trade skirmish or trade war and how it's developed in the last 72 hours.
Well, as I mentioned in my commentary in Foreign Affairs, that everybody loses from the trade war. So what has transpired in the past 72 hours, as you mentioned, last Friday, is, I think, a positive sign. It seems that they have made some progress, although we have seen this before back in June. So we'll have to see whether or not the parties will sign on the dotted line, in time, let's say, for the meeting between the two leaders, I suppose, next month.
The Global Times tweeted a few moments ago, quoting some customs officials in China, that it's a bright turn from a gloomy week, in their words, but that analysts are nervous about unpredictability, citing U.S. flip-flops in past trade talks, and they tagged the president, Donald Trump, on Twitter. Does that accurately reflect the view in China that they're mistrusting of the United States in holding on to their commitments?
I think there's some sense in that, so we'll just have to see what eventually happens, because as I mentioned, it has happened before, since back in June. So now they, I think, have reached an understanding, but the devil is in the details, so they have to work out the details and agree on a piece of paper.
Shan, in your op-ed, you say that the numbers suggest that Washington is not winning the trade war because tariffs hit U.S. consumers harder than their Chinese counterparts. Does that mean that China has more leverage as it negotiates this trade war?
Not necessarily. I think both parties lose from the trade war, but the numbers suggest that the damage to the U.S. side is greater in percentage terms than to the Chinese economy. That doesn't mean that the Chinese economy is not severely damaged. And I think for China, the business confidence in particular has been hit very hard in the past 15 months or 1.5 years. So I think some progress on trade negotiation will be positive for both sides.
Sean, given your history of deal making and how much experience you have in M&A, I mean, there have been reports here in the U.S. in recent weeks that the administration here could potentially put restrictions on capital flows to China. You're also seeing some tighter standards be floated right now by lawmakers around CFIUS. What do you expect to happen in terms of cross-border deals and also just investment flows moving forward?
Of course, any restriction on capital flow is bad for investors. But from my point of view, as an investor, and we invest billions of dollars in Asia and in the United States and in Europe as well, capital flow restriction is always bad. But in this world, there's a lot of capital. There's a lack of investment opportunities. And therefore, I think the provider of capital typically suffers if there's a restriction on where to invest, whereas it is actually more difficult from our point of view to find good investment opportunities. I think such restrictions, again, will be bad for all the countries involved, especially for investors. And from our point of view, we represent many of the American investors, and we have many state pension funds as our limited partners, investors, and they have benefited enormously from our investments in Asia, especially in China, in the past 10 years.
Are you concerned about the ability of those limited partners to be able to continue investing in Chinese private equity firms, given some of the restrictions that have been bandied about in Washington?
I certainly will hope so. You can never tell, but I hope so, because I think it's mutually beneficial. You know, like trade is never one-way street. It's always two-way, mutually beneficial, and therefore, when people look at the benefits that you will lose, I think people will think twice about taking it away.
Finally, the president here likes to talk a lot about supply chains being disrupted in China, manufacturers pulling out their supply chains, moving to other countries like Vietnam. Would you argue that that's happening at scale, and is it enough, given China's job growth, to create any kind of disruption in overall employment?
It is happening, and in fact, it has been happening for the past 10 years as labor costs rise and as currency strengthens in China. But I think with the trade war, of course, that process has been accelerated. But jobs are not going away from China to America because of the large gap in labor costs, and they're going to Southeast Asian countries and to Mexico perhaps. So it's having some impact on the Chinese economy. But it is not going to be very substantial. And the truth of the matter is, in my view, trade war is somewhat yesterday's war. Today's war is how you get to the consumer market. The Chinese consumer market now is $5.8 trillion. And look at semiconductor companies in the United States. They sell 2.8 times more. The top 10 semiconductor companies in the United States sell 2.8 times more in China than in the United States. So, as China moves some of its manufacturing away to Southeast Asian countries, some other American companies and foreign companies are moving into China to take advantage of the growing consumer market. General Motors sells more cars in China than in the United States. So that's the reality. Competing for Chinese consumers, I think, is the next game.
Sean, we thank you for your time. A lot of information, a lot of big corners that investors are still trying to see around. Thank you very much.
When we come back, Boeing CEO gets stripped of his chairmanship. We'll tell you who is taking on that role and what it means for the future of the company. We got Squawk on the Street back after this break.
If you can drive a van that's built in Britain, with class-leading fuel economy on every run, to Middlesex to do some masonry, or to Tunbridge carrying well over a ton, yours is the all-new Vauxhall Vivaro, and you'll be driving a great Brit van, my son. All-new Vauxhall Vivaro carries British business. To find out more, search New Vauxhall Vivaro.
Carl's all-change casserole.
So, Chloe walks in from school, tears all over her face.
Daddy,
She says,
I don't want to eat animals anymore.
I blooming love my meat, but not as much as I love my little girl. That's why we've made some changes to our old favourite, sausage casserole. Now with meat-free Cumberlands, but still with my magic touch, a dollop of mango chutney. Just as tasty as it used to be.
Better, actually.
Make your own with the new Tesco Plant Chef range, Food Love Stories, brought to you by Tesco.
When it comes to keeping your small business valuable information safe, Dell's small business technology advisors can recommend tailored security solutions, like computers with Intel Core processors, servers, storage, networking, plus industry-leading monitors and software. Running your own small business is a big challenge, but with the right partner, it's a lot easier. To speak with an advisor today, call 0800 085 4878. That's 0800 085 4878.
TuneIn puts you on the sideline for the 2019 college football season free all year long. With college football on TuneIn, hear the home and away call for more than 140 schools live, regular season matchups and rivalry games, conference championships and bowl games, the college football playoff.
Throw it. He's got it. Stiff arm. End zone. Touchdown.
You can listen to it all for free at home, on campus, or on the road. Hear the excitement and pageantry of college football all season long, free on TuneIn.
Good. Here's a swing and a drive deep to right field. Looking up. Goodbye, baseball.
Between game-winning shots and walk-off homers, follow TuneIn on social media to discover the latest and greatest in live sports.
With the 24th pick in the 2019 NFL Draft.
From live reminders that the biggest MLB games are on the air, to recommendations of the best new sports talk shows and podcasts.
He's going to be fine. He's going to be good right away in 3 years.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Good morning, everyone. I'm Sue Herrera.